The cheapest mortgage loans out there are conventional loans, conventional financing, which is, the loans that are backed by Fannie Mae and Freddie Mac. It's basically the government-sponsored entities. Those are the cheapest forms of mortgage money out there by far.
Hey guys, my name is Julian Castle. I'm with the Real Estate Investors Group, and today I have a very special guest. His name is Marco. Marco is going to help us understand why we should invest out of state. And I always like to start my podcast with this question. What would you do if you suddenly lost everything today? So Marco, thank you so much for coming on today. How you doing?
I'm good, Julian. How are you?
I'm good. So you suddenly lose everything today. What would you do?
Well, that's a scary question to think about, actually. But assuming you retain your knowledge, like your experience or your knowledge from, what you've done in the past, it kind of makes things a lot easier. So if I lost everything today, I've always been entrepreneurial and I've always been invested in real estate. I've just been an avid real estate investor. I would go back and do what I did in the past, but I'd be able to do it again faster, because when you have that knowledge and you have the experience from what you've done in the past, you know what mistakes to avoid because you've done them and you know where to get going. So for me, I got started in selling real estate, as a real estate agent. And then I got my broker's license. And while I was doing that, I was investing in real estate. So now that I've done it and I know how to do it and how to build a portfolio of real estate properties, I can go back and do it again. And I know what to look for, where to look for it, the type of financing you need, how to get financing quickly, how to bring on partners and raise capital. Those are the things I've done. So that's what I would do. I would just do it again today, but I would just do it faster with fewer mistakes and probably better, because, I can wipe the slate clean and just kind of start fresh. So I don't know if I'm answering your question, but that's essentially what I would do. Just take the knowledge that I've gained over the years and apply it to doing what I've done before.
Gotcha. Yeah, that does answer my question. And we're going to go in depth into your answer. So you would say that first thing you would do is to get your real estate agent license, right?
Well, if that's what you want to do, and I mean, not everybody wants to get a real estate, license because they want to sell real estate. I got mine, I guess, for two reasons. One is to give me access to the multiple listing service, the MLS, so I can see the properties that are available, at least in my local market, for the purposes of investing. Today, my philosophy is different. I believe that you should live where you want and invest where it makes sense. And that means you could be investing literally 2,000 to 3,000 miles away from where you live. Because I'm here in Southern California, as you can see behind me here. But when I started, I was investing 3,000 miles away in states like Michigan, Georgia, and Florida. So I was market agnostic early on. My first property was here in California. And then my next property was in Michigan, and then my next property was, in Georgia, and then in Florida. So I am market agnostic, but I got my real estate license because I wanted access to the multiple listing service. But the other reason is I just, being a salesperson and an entrepreneur, I wanted to make money. And, everybody thinks that real estate agents make a good income. Well, that's not actually the truth. The reality is 90% of all the income in real estate is made by the top 20% of real estate agents. So it's kind of the 90-10 rule there. But I wanted to sell real estate because I wanted to get those big fat commissions, in order to generate a good income that I can spend and, enjoy and then also invest. But so long story short, getting a real estate license is an option for a lot of people, but not everybody's suited to be in sales or a real estate agent, but it can be a tool that can help you if you're looking to invest in your backyard.
Gotcha. Okay, so what would be the first step that you would take?
In what?
Into building this back up. You invest now out of state. So what would be the first step?
So if I was, what's the first step I would take if I was to get started again? Oh man, well, I would probably, for me, I don't think I would need a real estate license knowing what I know today. What I would do is I would just build a team in the market I would want to invest in, or the markets that I would be wanting be wanting to invest in. And then if I wanted to fast track it, I would start raising capital. I would go out and find the deal or the deals that I want to invest in. And then once I have that identified or probably under contract to control it, I would go to my network of friends and other investors, people that I know, and start raising capital for the down payment. So in other words, I would find the deal, I would work the deal, I would manage the deal, and I would raise the capital so I don't use any of my own money or very little of my own money. So
Okay.
that's called a partnership.
Mhm.
Some people refer to that as a syndication or a group investment. It's essentially the same thing. But that's kind of a way to fast track your involvement in real estate. And in the process of doing that, if you want to buy your own real estate that you own and hold personally, without partners, just make money. I call it building chunks of cash. You accumulate, chunks of cash, and then you take those chunks and you deploy them as investment capital into your own deals, whether it be a single family home or a duplex or a fourplex. You start building your own personal portfolio.
Okay.
So those two things, are not mutually exclusive. You can do them side by side. Some people prefer one, some people prefer the other, and there's nothing wrong with either one of them or doing both of them.
Got it. Okay. So first step is find a market. Is that correct? So how would you find a market today? Can you please teach us how to find a market?
Well, the general rule for me in identifying a market, there's a couple things you want. One is, do the numbers work? And two, are the fundamentals strong? What I mean by that is this: the markets I like to look at are markets that have, at a minimum, stability. They're markets that are not declining in population. They have a good job market. The best markets are the ones that are growing, markets that have population growth and job growth, because the job growth means that people can make money and pay their bills, and it brings people into the market. When you have people coming into the market, it creates demand for housing. And that demand for housing means that people are going to be lining up to get into the rentals, your rentals, and they're going to be lining up to buy new properties as they're being built. So job growth leads to population growth, and population growth leads to growth in the housing market. It provides demand and stability. So those are the types of markets I want. But there are a lot of markets that are overpriced that have those characteristics. So you can't just look at that alone. You have to go to markets where the numbers make sense. So you don't want to be in a market where a single family home is $1 million. Ideally, you want to be in a market where a single family home is like $100,000 to $250,000, because there the numbers will make sense. The rents will help to pay the expenses and the debt service on your property, so you have cash flow and you can build equity over time. So those are the fundamentals, and then the numbers. Those are the two things I look for in a market.
Got it. Okay. So job growth and the numbers to make sure that it makes sense by having a housing, single family house costs around $100,000 to $200,000, so that the cash flow makes sense. Now, you mentioned you need a team. So can you teach us how to get a team in that market?
Well, your team is going to be based on, 4 or 5 key people. One is your, what I'll call your acquisitions person or company. That could be a real estate agent, could be a real estate broker. It could be a turnkey property provider, like our company here at Norada Real Estate. We kind of provide the due diligence and vetted properties along with everything else that you need. So it kind of shortcuts a lot of things for you. It does a lot of the work. Like 90% of the work is done for you. But you need somebody or some service provider providing you those deals, the properties. The second person on your team would be, if you don't plan to self-manage, which most people don't, and I don't recommend that most people do, you need a property manager, full service, professional property manager or management company to manage the properties that you're acquiring. Thirdly, you need your lender or lenders. That could be, institutional lenders, could be banks. Usually they're mortgage brokers or mortgage lenders that focus on lending mortgage loans to real estate investors. They're what's called non-owner occupied loans. There's many of them around, but typically you're not going to go to a bank or your typical lending institution to get a mortgage loan. That's just not the best way to go about it, and they don't specialize in doing those types of loans. So your third is your lender or mortgage broker. Those are the three key people you're going to need. Beyond that, you're going to need an asset protection attorney or / real estate attorney and a tax advisor of some kind. You're going to have someone potentially doing your books, or maybe you're doing your books, but then you want someone who's like a qualified tax professional, like a CPA who understands investing and real estate specifically. That's your core 5 of people. Beyond that, you're just going to have people who are transactional, like inspectors, maybe plumbers, the title companies, etc. They only use them when you need them. They're very transactional. But the other people you're going to use as you continue to build your portfolio and grow.
Gotcha. Okay, so number 1 is the deal source. Could be a real estate agent or a company like you. Second is a property manager. The third is a lender. The fourth is a lawyer. And the fifth is a CPA for tax.
Pretty much.
And then you have your vendors.
Yep, exactly.
And then now that you have this team together, how do you raise the capital when you find a deal? That's the third thing you mentioned.
Yeah. I'll try and give you a simple answer, because it's not always a simple answer. Where you start is with friends and family, essentially, right? It's the people you already know. So you start with your closest inner circle, friends, family, and other real estate investors that you know. Beyond that, it becomes a little more difficult, because now you're starting to have to get out there and network, contact other investors, ask for referrals, people that you know, the people that they know, and maybe visit investment clubs and real estate events and real estate REI meetings, like real estate investor meetings. You need to start to get out there and build a list. You need to build a list, an email list, a database of people that you can contact that are interested in real estate investing, but don't want to be active real estate investors. They want to be passive real estate investors, and you're the one doing the work. So they're going to, look at you or come to you when they want to invest, or when you have the right deal that you can present to them. And then they're going to say, hey, actually it's the right time. I'm looking for something and I like your deal, and, let's do something. So you really need to build a list. The only other way around that is this gets a little more advanced, maybe outside the scope of, what we're talking about here, but you can, create an offering with a securities attorney where you can raise capital from the general public. And that's called a Regulation D or Reg D filing. And there's 2 types, one where you can advertise and one where you can't. The one where you can advertise, you can only work with accredited investors, but it allows you to solicit investors. The one that's called a 506B, the other one was a C. The 506B, you can't advertise, but it allows you to raise capital from up to 35 non-accredited investors. The others have to be accredited. So there's some limitations on each as far as what you can do. But if you're looking to go raise capital from people who you don't know, that are not friends or family, typically you're going to be registering a filing with the SEC, just to disclose that you're going to be raising capital from the public, and then you go out and raise the capital.
Got it. So how would you approach someone like a friends and family or someone you met at a meetup? Is there a specific script someone could say that would allow them to get this person know most of what you're doing, or get to know what you're doing, and then opt in if he wants to or if she wants to?
If you're in a networking environment, it just usually comes up in conversation. Just say I'm a real estate investor. I put you could just say that, I put real estate deals together for other real estate investors, or a lot of people don't understand the term syndication, but you can say I'm a real estate syndicator. I put, real estate deals together for other investors. All you're doing is just fishing for interest. If someone says, "Oh, tell me more," or what kind of real estate deals are you working on, something like that, then they're opening the conversation. And at that point, you can share more information. And if they say, "Yeah, that's something that I could be interested in. Well, you just get their contact information and follow up with them later. You're not trying to hard sell everybody. That approach works well. It's not a fast approach, because you're working one or two people at a time, as you go to events. You could bring flyers, you could advertise, you can promote, you can even advertise online. You just have to be careful if you're raising capital that you have a filing in place. So,
Got it. Okay, perfect.
there are books on this, by the way. There are a lot of books. If you look on Amazon, there are books on how to raise capital and how to structure real estate syndications. There's many of them, so it's not like there's no information out there. It's out there.
Got it. Okay, so I want to circle back to the first step, which is you find a market, and then how do you get the numbers to work? How do you get the education to learn if this deal or this market makes sense?
A really quick and easy way to do that, because your question can get pretty detailed because it really depends on the market. But here's a quick and dirty way.
Mm-hmm.
If you look, there's something that they used to call the 1% rule. The 1% rule today doesn't really apply much anymore because the numbers across the country have gone up so much. Property values have appreciated so much that they've appreciated faster than the rents. And so what used to be a 1% rule today is what I'm going to call the 0.8% rule. But basically it means this: if just simple math, simple example, if you had $100,000 property and that property rents for $1,000 a month, 1,000 divided into the 100,000 is 1%. So if the monthly rent is 1% of the purchase price, you've met the 1% rule. Now, again, that's hard to do today unless you go to smaller markets or much like suburbs that are further out from the kind of the central cores of the larger markets. Another way to achieve, something close to 1% is to go to less desirable neighborhoods, which I do not recommend at all. So meaning you're downgrading from where you might be investing in a B class neighborhood and you're going to a C class neighborhood. Again, I don't recommend or advise you do that because you're bringing up all kinds of potential problems with being in those less desirable, sketchier neighborhoods. So if you want to deal with that type of, tenant class and demographic, knock yourself out, but I don't recommend it. But if you can find a property that's, close to 1%, the odds are the numbers are going to work out quite well, meaning that the rent will cover all the expenses plus the deferred maintenance items that you're going to have to budget for, and it'll cover the debt service, meaning that if you finance it and you fully leverage the property, you'll still have positive cash flow. So that's the 1% rule and how it works. That's how we used to do it, let's call it 8 years ago. But today, if you're finding a property that has a 0.8% rent to price or rent to value ratio in a good neighborhood, you're doing well. Now, having said that, some investors are pretty aggressive, meaning that they'll accept a lower rent to price ratio, like, 0.6, maybe 0.5. Now we're talking about California numbers here, which really don't make sense.
Yeah.
But what they're doing is they're borderline speculating on the appreciation, the price going up to hopefully far outstrip what they would have been getting in cash flow. So they're giving up on cash flow in the hopes that they're going to get a lot of appreciation. And that doesn't always play out. So you got to be careful. Don't become a gambler, meaning a speculator, when it comes to real estate investing. You want growth markets, but you also want a decent enough cap rate or cash on cash return so you have that cash flow while the property is increasing in value over time. That way you get the best of both worlds. You have the cash flow to keep the deal together. I call it glue. You have your deal glued together with the cash flow, and your equity grows over time because you're in an intelligent network, market or neighborhood or both.
Got it. Okay, so get us close to that 1% rule in growth markets and stay away from the bad neighborhoods.
Yeah, always stay away from bad neighborhoods. I made that mistake early on. I was in sketchy neighborhoods where it was just problem tenant after problem tenant, and every time a tenant, left, there was always a mess to clean up and a costly expense. So even if your cash flow is great, it gets eaten up very quickly when you have a turnover. So you want to minimize the turns on your properties. The fewer, the better, because that's where the expense is that eats up your cash flow.
Yeah, got it. And let's say one, like say, one of my audience was to find a property that meets close to that 1% rule. How does this person go a little bit more in depth to like really underwrite the property and see if it really makes sense? Are there some resources that you know of, or do you offer some resources?
You're talking about doing like a cash flow analysis?
Yeah, kind of like, the quick and dirty, 1% rule works. Like,
Yeah, you're talking about the numbers though?
yeah. Now to like more solidify, like be more certain of the numbers. Is there a further analyzation you can do?
Yeah, it's actually not hard. I could explain how it's done. There are tools online. You can find them. I don't have one specific one in mind yet, but we are actually working on one, building one, a free tool on our website that will be released here in the near future. In fact, I have a draft of the printout sitting on my desk here. But essentially what you do is you just put in the numbers on that property, the income and expenses, and fill in a few assumptions like what mortgage rates are, how much you're, planning to finance and that kind of stuff. And it does a 30-year cash flow analysis for you, with an equity analysis and financial performance numbers on it. So it really gives you a very good detailed snapshot of the deal. But the math is pretty simple. It's essentially this: you take your income, you deduct what we call a vacancy factor or vacancy allowance. You're gonna assume that your property will be vacant a percentage of the time over the course of a year or 2 years or whatnot. As a general rule of thumb, I just like to use 5%. 5% as a vacancy factor. That means I'm just budgeting for future vacancies, so that way I have the money for that vacancy as if the property was never vacant.
Yeah.
So you have your gross income, you deduct your vacancy, and then you deduct your expenses, which basically are your property taxes, your insurance. If there's an HOA fee, usually there isn't an HOA, and your property management. And then in addition to that, it's good to budget for maintenance and repairs. And this is just, it depends what you're comfortable with. I like to use 5%, but if you want to be more aggressive, put 10% or 8%. Again, you're not spending that money today, but you're budgeting in the pro forma as if you were spending it. And then what's left is called your NOI, your net operating income. This is the income the property is going to spit out and provide as spendable cash if you owned it free and clear. If you're going to finance it, then there's one more deduction. That's called your debt service. You're deducting, what your finance cost is every month. Essentially, it's the mortgage payment. So once you deduct your mortgage payment, what's left over is net cash flow. That is the bottom line, the net spendable dollars that the property's kicking out. With that, you can go and, spend it on a vacation, or you can save it and reinvest it in another property. But that's really how complicated it is. It's really not. The cash flow analysis is pretty simple. As long as you have the right numbers, you know what the income and the expenses are, you can come up with a pretty accurate cash flow analysis. And then you just got to be happy with the bottom line numbers. Are the numbers, acceptable to you? Is it the cash flow you want to see? Is it the cash on cash return you want to see? If it is, then, you move to the next step in your due diligence on that property.
Got it. Okay, so I think we covered how to underwrite a deal, how to find a team of people, and how to raise the money. Now, let's say you got a hang of this. How do you scale?
Well, if you're scaling individually, like by yourself, we already talked about one way to scale, and that is to raise capital and bring in partners, because your partners will bring the capital you need to do more deals.
Yeah.
But if you don't want a partnership, if you don't want to syndicate, then what you need to do is find ways to get more investable capital as fast as possible. because your ability to invest comes down to two things: capital and credit. If you've got good credit, you're going to be able to get financing. You don't need financing, but it helps a lot because you can buy 4 to 5 times the amount of property with credit than you can without it.
Yeah.
So the credit is good, but the capital is where people fall short. People run out of capital quickly.
Yeah.
So, so your ability to make more money, save more money, bring in more money, whether it's from your business, starting a new business, a second job, a pay raise, or if you're in sales, selling more, just earning more. However you do it, the more capital you get, the more you have to invest. So you got to think about, how do I make more money in a shorter period of time, so I have the investable capital to buy more property.
Got it. Okay, so I want to ask a question which comes to mind. These properties that you're buying, they're tied to a personal credit, or are they tied to a company like an LLC? Can you do it both ways? What are the differences, and what's the best way?
If you're buying
in order to grow.
If you're buying residential property, which is in lending world is considered 1 to 4 unit properties, so a single family, duplex, triplex, fourplex, then those mortgage loans are tied to your name personally. You have to qualify. It's you who's qualifying for the financing. Anything over a 4 unit property is considered a commercial loan. Those loans still require you to qualify, but the loan is much more heavily dependent on and based on the property's ability to service that loan and qualify. So they look at the property much more heavily than they look at you. Residential loans, consider the condition of the property and the location, but they look at your ability to qualify from an income perspective and credit perspective. So it really comes down to the type of property that you're looking at. So whether it's a residential or commercial loan. Now, having said that, I'll just go a little deeper. The residential side of it, the cheapest mortgage loans out there are conventional loans, conventional financing, which is, the loans that are backed by Fannie Mae and Freddie Mac. It's basically the government-sponsored entities. Those are the cheapest forms of mortgage money out there by far. It's government subsidized in a sense. So with those, you essentially have a limit of 10 per person, 10 per credit score. The first 4 are pretty easy to get. The next 6 are still easy to get, but the qualification criteria goes up a little bit. Once you get to 10, now you got to start looking at what's called non-conventional loans, sometimes called non-QM loans. But there are a lot of mortgage lenders out there that offer that type of financing. That type of financing is a little more expensive, but it has virtually an unlimited number of loans that you can get. So you can buy another 10, 20, 30, 100 properties with the non-conventional financing. It's just a little more expensive. That's all you need to know about it. But the qualification criteria is very similar to conventional financing. With commercial loans, the financing terms are a little bit different. The mortgage term is typically 25 years instead of 30. The mortgage rates sometimes, by the way, you have to do it in terms, like your amortization period might be 25 years, but you have 3 to 5 year blocks of interest rates. So it's a little more complicated, but that's just the way the commercial space works. So anyway, that's kind of a long-winded answer to your question.
Yeah. So people can have up to 10 loans with Freddie Mac and Fannie Mae, and then they can go into non-conventional loans, which they could go up unlimited, and they can, it's more expensive, but if the numbers still make sense, they can still, do as many as they like.
Yeah, right.
And so tell us about your portfolio. Is there a ballpark number that you can share in terms of like how many properties you have acquired and up until the first time you started investing?
Well, without giving specific numbers, like since I started investing full time, which was in 2003, late 2003,
Mhm.
I've been in and out, over 100 properties.
Mhm.
Those are buy and hold properties, not flips. If you want to talk about properties that I've flipped, it's somewhere in between 200 and 300 properties.
Gotcha.
So,
Yeah.
and the flipping was to generate chunks of cash, like I was talking about before. That was the purpose of the flipping. The flipping was to generate income that I would put towards down payments on buy and hold properties, the properties that I intend to keep forever, right?
Gotcha. Yes.
So it's just one of the strategies. And flipping is not an investing, by the way. A lot of people think, I'm going to flip property because I'm a real estate investor. Well, no. If you're a real estate investor, you're buying and holding property. If you're flipping property, you're a business owner, and your business is to buy, fix, and flip property. So don't get the two confused. You're not an investor.
Gotcha. Okay, sounds good. Okay, so you during your trajectory, you did fix and flips in order to get more money to put into
Yep.
these long-term rentals, buy and hold, which now you've been in over 100 deals, right?
Mm-hmm.
So I'd like to now switch over to your company, Norata. Can you tell us what it is and what it helps people do?
Well, there's several Norada companies, or Norada, however you want to pronounce it. There's Norada Real Estate Investments,
Mhm.
Norada Real Estate Funding, which is the mortgage lender that does the non-qualified or non-QM loans that we were talking about.
Mhm.
There's Norada Capital, which is a private equity firm, and we raise capital from investors and pay a healthy 12 and 15% interest to the investor on that capital. And there's a few other companies in there, but the 900-pound gorilla is Norada Real Estate Investments, and that's a company I started 20 years ago to help investors invest in real estate. So we provide them the properties. We have properties in 25 markets.
Mhm.
They're turnkey, so they're either brand new or like new. They're rent ready or tenant occupied. They're professionally managed. They're cash flow positive. They're in good neighborhoods. And then, we also provide investors with the financing options, the property management, and everything else they ever need. So it's a complete turnkey real estate investing experience with turnkey rental properties that investors own 100% of. We don't participate in any of the profit or the ownership or anything like that. We're just here to essentially provide the service of helping you build a real estate portfolio and educate you, along the way. The education comes free.
That's awesome. And so what are some ballpark average returns like or requirements that someone needs to have in order to qualify to be a perfect fit for your service for the real estate investing side?
There's no perfect fit because we work with newbies that are just getting started and never bought a rental property before. And we work with sophisticated investors who already have a large portfolio because they're just looking for a relatively simple and easy way to continue building or growing their portfolio. And they just know that we already have done a lot of the homework and research on the markets and vetted the providers and the properties that we have in our pipeline. So it's a fit for everybody, regardless of where you are, because once you've done one or two deals, it's rinse and repeat. It's just knowing that you want to stick to a particular market because you like that market, and you're just going to acquire one more property after another until you have your footprint there. And then you just move to another market, and then another market, depending on how big you want to grow your portfolio. It's one of the principles or rules that we talk about is just geographic diversification. You don't want all your eggs in one basket, meaning one market. But it's good to have some properties, like 3 to 5 in 3 to 5 different markets. That's kind of my rule of thumb: 3 to 5 properties in 3 to 5 markets.
That's awesome. So what does one need to bring to the table? How much like usually for investment?
Yeah, it's like what I was talking about before, the capital and the credit. If you've got the credit, I mean, again, you don't need credit if you're buying all cash, but if you're looking to get mortgage financing, you do need qualifying credit. 99% of the investors out there, like 99% of the investor clients we work with, have decent credit, so they don't have a problem with qualifying for that. But as we were talking about prices before. Your down payment, your capital requirement to come to the table with, as you're just talking about right now, comes down to the purchase price of the property. The minimum down payment is 20%. If you look at any of the mortgage loans out there, almost always 20% is the minimum. Sometimes it's 25, but 20%. So it's simple math at that point. The purchase price range for properties is on the low end 80,000. Again, this is market specific and neighborhood specific.
Yeah.
But 80,000 on the low end. On the high end is new construction homes like in Florida that are right around the 250,000, sometimes $300,000 price point. So that's a wide range. Let's just call it, 100 to 250. The math is simple. 20% of whatever that number is.
Yeah.
So 20% of $100,000 property is $20,000. If you're looking at a $200,000 property, 20% is $40,000. $150,000 property, it's $30,000. Plus, of course, there's some closing costs. There's going to be a small percentage in there for the closing costs and lenders fees and whatnot, but it's going to be close to 20% down is what you're looking at.
Got it. And for someone who's getting a turnkey service, what's you would say like the return on investment on their down payment, right? Is there a ballpark, a range?
Again, that's a very it depends type of answer because it depends on the market, the neighborhood, and the actual numbers on those properties. But what we're seeing today in most of the investable markets and neighborhoods, meaning the places that you would actually want to be in and rent, are going to range. When we talk about the properties in terms of cap rates, like capitalization rates. If I assume you understand what I'm talking about, but if you talk about cap rates, they're going to range from roughly 5 to 8%. 8% is on the higher side. 5% is much more closer to the norm today. 5, even 6% cap rates. If you're financing it, then your cap rate becomes your cash on cash return, and that becomes a little bit higher because you're using leverage. So now instead of 5 to 8, it could potentially be 6 to 10% as far as a cash on cash return. So it's still, the numbers still make sense. Again, it's market and neighborhood specific. It's not like what it was 5 to 8 years ago when, it was an ideal time to be getting into real estate heavy. The numbers still work. The market's still growing. I'm very bullish on the housing market. We still have a deficit of housing units in the country. We have a lot of tailwind as a real estate investor today, very little headwind. So it still makes a lot of sense to be investing in real estate today. It's just you have to be a little bit more picky and choosy with what and where you're investing in.
Got it. Okay, so for the people who are listening, a cap rate is a fancy term to know if you were to go full cash in on a property, how much would your return be? So if it was $100,000 property, a cap rate of 8% would be $8,000. You would net every single year. Now, when you put a down payment in, that's a cash on cash return. It becomes higher because the money invested is now lower, and you're getting leverage from the bank's money or your hard money lender. And so that's why, it goes up to like 10%. And Marco, I want to touch on something which is, part of the reason why we're talking today, which is you mentioned that you recommend people that have 3 to 5 properties in every major market, or like the desirable markets. Can you tell us why?
Well, it's actually three to 5 properties in 3 markets, maybe 4, maybe 5. Yeah. The reason I say that is because, one, it gives you geographic diversification. You're not, you don't have all your eggs in one market basket. So you're spread out, amongst, let's say, 2 or 3 different states. So, if there's fluctuations in the local economy and the economy in general, you're spreading out the impact that changes in the economy have. Second, that's a great portfolio size. If you've got 3 properties in 3 markets, you've got 9 properties. Even if you're buying like 1 a year, over the course of 9 years, you're going to have nine properties, and they're spread out across 3 different markets. So that could be, anywhere from 9 to, let's say, 15 or even 20 properties, depending on how big your financial goals are and how much passive cash flow or passive income you want from the properties that you're buying. so that's just a good number for most people. Most people will achieve their financial independence goals, with 9 to 15 properties. They'll gain equity and they'll gain cash flow over time. So that's why I just use that rule of thumb: 3 to 5 in 3 to 5. It covers the income goals, the wealth goals, and the diversification requirements. So, but if you have bigger goals, shoot for the moon, like go for 40, 50.
That's good. Cool. So, I guess people now have an understanding of why they should be in different markets, and what is that good number for them to be financially independent. Now I want to talk about, tell me something that real estate has been able to achieve in your life. What?
Time freedom. That's, I think, what most people want. They're not. Most people are not, investing because they want money for the sake of money. Money is just a tool to get you to, pay the bills, get groceries, travel, enjoy whatever, in life. But at the end of the day, what we want to do is we want to have freedom, right? Time freedom and freedom to do what you want, when you want, with your family and your friends and whatnot. But in order to do that, you have to have not only all your expenses covered, but you need to have spendable, disposable income, and that comes from the passive income from your investments. And so, that's what it's helped me to do. It's given me the freedom to work where I want, when I want, with who I want, and travel, and spend time with my family and my friends and all that good stuff. So, I mean, that is what it's helped me to do, and that's what it helps thousands of real estate investors to do, and that's what a lot of us people aspire to do. That's where they want to get to.
Yeah, yeah, that's amazing. So, what are some hobbies that you picked up now that you have time freedom?
I still work like a dog, man. It's I wouldn't say I picked up hobbies, but one thing I do really like and enjoy, and I do spend not a lot of time on, but enough time on, is playing poker tournaments.
Oh,
So I play in quite a few poker tournaments, sometimes in Southern California, but often in Vegas. I'll go into some pretty big tournaments. So
cool. All right.
yeah.
So you like poker? That's awesome. That's a cool hobby.
Yeah, I love poker, and I love to travel. I like to see different cities and different countries, and just explore different cultures, different food. Go to the various sites and museums and whatnot. Travel's fun. Like, everybody should travel to explore the world that they live in. It just amazes me how many people never really live the county they live in, even the state. They haven't even seen their own country, let alone the world. So
Yeah, that's true. That's amazing. And I want to touch on, do you have kind of a case study you could share, maybe a client of yours, for example, that you helped get to a certain desirable level, that would resonate with someone in the audience?
it's pretty vanilla and boring, like, because the process is the same for everybody. The only difference is who the person is, and the market and properties that they're buying. But when you step back and just look at it big picture, it's the same. But when you were asking me the question, one person did pop into mind, a guy named Lance. He used to live in San Diego. I'm not sure where he's living now. But he came to us as a newbie, just a green investor, and bought his first rental property through us this many years ago.
Yeah.
And he's pretty sharp and aggressive type of investor. He definitely wanted to make as much money as he could, as fast as he could, to invest in real estate, because he wanted to build a rental portfolio. So from one, it went to two, and then he went to four pretty quickly, because he had the capital to invest as down payment capital. But he kept building his portfolio quickly, and he kept working with us to add properties to his portfolio, because we were helping him all along. We kind of opened his eyes and opened the doors for him. And I think he came in through our podcast, if I'm not mistaken. He was listening to my podcast the passive real estate investing show, and that's how he came to us. But then he got aggressive and he started, which I'm glad he did. He started venturing out on his own and doing research in different markets and finding properties in different markets. So he was adding property to his portfolio as well from just other sources. And then he started buying distressed properties and fixing them up and then refinancing them and keeping them. So he was building his portfolio yet a third way. But that all started with our podcast that led him to a phone call, and I talked to him, and then, got him started with his first property in the Midwest somewhere. And yeah, I mean, young guy too. I think he was in his late 20s. So, he's definitely a great client and a great success story. And it just goes to show you what you can achieve if you put your mind to it and you just focus and take action.
That's amazing. I love that case study. That story is phenomenal. Now, when it comes to your podcast, can you tell us a little bit about what you talk about in your podcast? What people can expect to go see if they go check you out?
Yeah, I mean, even though the title sounds pretty specific, like niche, when it's called passive real estate investing, we talk about everything from real estate investing strategies to tactics to market spotlights to tax strategies to personal development and mindset to just wealth creation in general, self-directed retirement accounts, the mortgage landscape, where mortgage rates are headed, and why mortgage rates are not the be all end all, why that's being very narrow or myopic. What I try and do once a month is a housing market update. What's going on in terms of housing, mortgage rates, the economy, where are we headed, what markets are doing well, which ones are contracting, just kind of an overview of housing and the housing market and the economy. So investors really like that kind of information. So yeah, it's just a wide range of topics. So
That's
it's
amazing.
something for everybody.
Can you tell us a little bit about what's I know you don't have a crystal ball, but just what's your opinion on the upcoming months or year or two? Some people say there's going to be a recession. I just want to know what your thoughts are, your opinion.
Well, everybody has an opinion, and nobody has a crystal ball, so it's really hard to know. I think what we're seeing today is what we're going to continue to see for the next 3 to 6 months. Mortgage rates are probably not going to change all that much. They might go up a little bit more, but I think ultimately in time they'll probably come down more than what they're at today. I think inflation will, within the next 12 months, be under control again, to where where we had them before, in between 2 and 3%. There's still a strong market in employment, so jobs are not a problem. Housing is really where we've seen a recession. If you want to break it down, housing is where we've seen a recession, because things were contracting. Builders stopped building, people were getting laid off, or there weren't a lot of jobs for the contractors that were out there. So it was a break, maybe a good break. But as far as the economy in general, things are humming along. It's still a strong economy. There's jobs. There's businesses are growing. The retail sector has been suffering a bit. A lot of bankruptcies and struggling brick and mortar type businesses. But that writing was on the wall a long time ago, and it's just been a slow, painful death for a lot of retailers over the last 10 plus years. So, but yeah, I think, I don't think we're going to see a deep recession going forward. I think I'm more bullish than I am bearish. In fact, if anything, I think we're going to have probably a very strong 2024.
Gotcha.
So if you're thinking whether I should get involved in real estate investing or not, go for it. The deals are out there. They're always out there. It's not a question of when, it's a question of where. And, that's what we help investors do all the time. But good or bad economy, people need a place to live. housing's not going anywhere. You know, we'll always have a housing market. So just get involved, because it's a train that keeps moving and won't stop. You know, you just got to get on it at some point.
That's great. Yeah, thank you, Marco. So if people want to go visit you, where can they go?
Yeah, I mean, I can give you all kinds of places to go, but I guess the two places I'll leave you with is our main real estate website, which is noradarealestate.com. That's Norada, Norada Real Estate. And my personal website, where you can find links to all the things I'm involved in, from Broadway to, you know, private equity firms, is just my name, marcosantarelli.com. And if you have show notes, you could pop it in there, but it's just my name, marcosantarelli.com.
Amazing, amazing. So I really enjoyed the conversation with you today, Marco, and I'm sure my audience also did too. So if you really enjoyed the conversation with Marco, I'd like you to go check him out and maybe send him a message through his website or something, say thank you. And if you want to connect with him, he's available there. And I'd like to have Marco on in the future as a guest. So that'd be a great thing for you guys to interact with Marco. So thank you, Marco, and I hope you have a good day.
Julian, thank you so much. It's been fun. Appreciate it.